Welcome to Skytech-Lens. In the summer of 2025, Washington stunned the world with a move that would send shockwaves through the global economy. The US government, after weeks of speculation and mounting tensions, announced a sweeping new set of tariffs targeting Brazilian imports. The decision was made public in a high-profile press conference, with officials emphasizing the gravity of the situation and the need for decisive action. These tariffs were not minor adjustments, they were steep, reaching up to 50% on a wide range of goods from Brazil. Everything from agricultural products to manufactured goods was suddenly subject to these new, punishing rates. The move caught importers and exporters off guard, as shipments already en route faced an uncertain fate at US ports. The official explanation cited a complex web of political and economic disagreements. US representatives pointed to ongoing disputes over trade balances, regulatory standards, and even referenced Brazil's internal legal affairs, including recent judicial reforms. It became clear that these tariffs were about more than just economics. They were a signal of deeper diplomatic rifts and a warning shot in a broader geopolitical contest. For Brazil, the announcement was a direct affront to its sovereignty and national pride. The government responded with outrage, calling emergency meetings and condemning the US action as unjust and provocative. Diplomatic relations, already strained, deteriorated rapidly. Billions of dollars in annual trade were suddenly at risk, and the future of cooperation between the two nations was thrown into doubt. The impact on Brazil's economy was immediate and severe. Key industries such as agriculture, mining, and automotive manufacturing had long relied on the US as a primary export market. Now, overnight, they faced an existential threat. Factory workers, farmers, and business owners across Brazil watched anxiously as orders were canceled and production lines slowed. With little warning and no opportunity for negotiation, Brazil's leaders were forced into crisis mode. The finance minister addressed the nation, outlining emergency measures and calling for unity. Business executives scrambled to revise forecasts and develop contingency plans, knowing that the country's economic strategy would need a rapid and dramatic overhaul. The consequences of the US move rippled far beyond the two countries involved. Global supply chains, already under strain from previous disruptions, now face new bottlenecks and uncertainties. International markets reacted with volatility, and consumers around the world began to feel the effects as prices rose and store shelves emptied. As the news dominated headlines, business leaders and financial analysts scrambled to assess the full impact. The world watched closely, realizing that this was not just a bilateral dispute, but a pivotal moment that could reshape the future of global trade and international relations for years to come. Brazil wasted no time in responding to the mounting pressure from the United States. The government, aware of the stakes, acted swiftly and decisively, determined to protect the nation's interests and assert its sovereignty on the world stage. Behind closed doors, top officials convened emergency meetings, weighing their options, and preparing a bold counter-move that would send a clear message to the international community. The first step was immediate and unmistakable. Brazil canceled all high-level diplomatic talks with the US, a move that reverberated through diplomatic circles. This was not just a symbolic gesture, it was a calculated signal that Brazil would not be intimidated or coerced, and that it was ready to defend its autonomy, no matter the cost. In the days that followed, the government unveiled Plan B, a sweeping strategy designed to fundamentally shift Brazil's economic trajectory. The plan called for a dramatic reorientation of exports, moving away from traditional reliance on the US market, and instead forging stronger trade ties with Europe and Asia. This was a bold gamble, but one that promised new opportunities and greater independence. At its core, Plan B aimed to diversify Brazil's trade portfolio, reducing the country's vulnerability to external shocks and building a network of resilient, mutually beneficial partnerships. By reaching out to new allies and opening fresh channels of commerce, Brazil hoped to secure its economic future and lessen the risks of overdependence on any single partner. The government wasted no time in putting this vision into action. Trade delegations were dispatched to key capitals across Europe and Asia, while new support programs were rolled out to help Brazilian exporters break into unfamiliar markets. The message was clear. Brazil was open for business and ready to compete on a global scale. President Lula took to the airwaves, framing the government's response as a matter of national pride and independence. He called on Brazilians to unite behind the new strategy, emphasizing that this was not just about economics, but about the country's dignity and its right to determine its own destiny. The public responded with enthusiasm, rallying behind the government's bold new direction. The world watched closely as Brazil charted a new course. International headlines buzzed with speculation and analysis, while global leaders took note of Brazil's determination to forge new alliances and safeguard its economic future. The country's assertive stance sent ripples through the global marketplace, signaling a shift in the balance of power. The unveiling of Plan B marked a pivotal turning point in Brazil's modern history. It demonstrated the nation's readiness to adapt, innovate, and thrive in a rapidly changing world, proving that, even in the face of adversity, Brazil could seize control of its own destiny and emerge stronger than before. The tariffs hit home for around 10,000 Brazilian companies, sending shockwaves through the heart of the nation's industrial and export sectors. These weren't just numbers on a spreadsheet. These were real businesses, employing millions, suddenly facing a future filled with uncertainty and risk. For many, the US had long been their most important customer, a market that provided stability and growth for years. Many of these companies depended heavily on the US market, building their operations, supply chains, and even their business models around American demand. The sudden imposition of tariffs meant that overnight, their most reliable source of revenue was threatened. Suddenly, their products became uncompetitive, contracts were in jeopardy, and established shipping routes were thrown into chaos. Warehouses filled with unsold goods and long-standing relationships with US buyers began to unravel. The uncertainty rippled through every level of the supply chain, from factory floor workers to top executives. Exporters scrambled to reroute cargo to Europe and Asia, facing higher freight costs and fierce competition for shipping space. Insurance premiums soared, and the logistical challenges of entering new markets were daunting. Many companies had to quickly learn the regulations, preferences, and business cultures of entirely new regions, all while racing against the clock to keep their goods moving. Financing became harder to secure, putting immense strain on working capital. Banks grew cautious, and credit lines tightened, leaving business owners scrambling to cover payroll and operational costs. The financial stress was felt most acutely by those with thin margins and little room for error. Medium-sized businesses in particular faced a perfect storm of rising costs and shrinking margins. Many were too large to pivot quickly, but too small to absorb heavy losses. Family-owned enterprises and local manufacturers found themselves at a crossroads, forced to make tough decisions about layoffs, production cuts, or even closing their doors. The crisis forced companies to rethink risk, diversify markets, and innovate supply chains. Business leaders gathered teams to brainstorm new strategies, seeking out alternative markets and partners. Supply chain managers worked overtime to track shipments and find the most efficient routes, while executives negotiated with new buyers across the globe. Painful as it was, this upheaval sparked a wave of adaptation and resilience across Brazilian commerce. Companies invested in new technologies, retrained workers, and found creative ways to stay afloat. Some even discovered unexpected opportunities, forging partnerships and opening doors to markets they had never considered before. The lesson was clear. Over-reliance on a single market is a risk no business can afford. In a rapidly changing world, adaptability and diversification became the new watchwords for survival and growth. The tariffs' effects rippled through everyday products and industries. Brazil's coffee producers, suddenly priced out of the US, scrambled to find new buyers, while American consumers faced higher prices. The egg market was thrown into turmoil, with US food companies losing a vital supplier just as they needed it most. Tariffs on metals like steel and aluminum drove up costs for US manufacturers, threatening delays and price hikes across industries. Even Brazil's meat exporters had to pivot quickly, targeting Asian markets and adapting to new standards and consumer preferences. The disruption exposed the deep interdependence of global supply chains. For both countries, the fallout was immediate: higher costs, supply uncertainty, and a scramble to adapt. The message was unmistakable: trade policy decisions have real, far-reaching consequences. To help businesses weather the storm, Brazil's government rolled out swift, practical support. Export credit insurance was expanded, banking guarantees were offered, and tax refunds for exporters were accelerated to boost liquidity. A new single-window customs system streamlined paperwork, while port and rail logistics were optimized to speed up shipments. A simple one-page customs guide clarified regulations for new markets, reducing costly errors and delays. These measures gave Brazilian companies the tools and confidence to compete globally, even in the face of sudden upheaval. With the US market closing, Brazil turned to Europe and Asia as new trade frontiers. The EU-Mercosur trade deal gained momentum, promising lower tariffs and stable, rules-based commerce, if Brazil met strict environmental and labor standards. Meanwhile, Asian markets like China and ASEAN offered speed and flexibility, with China quickly approving more Brazilian coffee suppliers. Exporters faced longer, more complex shipping routes, but valued the predictability and reliability of these new partnerships. The pivot wasn't without challenges, but it brought stability and new opportunities. Brazil's diversification strategy was clear: build a balanced export portfolio, reduce risk, and secure long-term growth. The shift marked a new era for Brazilian trade, less dependent on any single partner. In a volatile world, resilience through diversification became Brazil's guiding principle. The tariff crisis underscored a basic truth: business thrives on predictability. Unclear U.S. rules left exporters and buyers in limbo, unable to plan or price goods accurately. In contrast, Brazil's reforms, like the one-page customs guide and single-window system, provided the clarity companies needed to adapt. Streamlined processes reduced delays and costs, making it easier for businesses to enter new markets. The episode highlighted the value of rules-based trade systems, where disputes are resolved through established procedures, not sudden policy shifts. For companies, clear rules mean confidence to invest, hire, and grow. Brazil's pivot was a move towards stability, the foundation of successful global commerce. U.S. companies too faced a scramble to adapt. With costs on Brazilian goods soaring, many sought new suppliers, but replacing established partners proved difficult, especially for specialized products. Some renegotiated contracts, sharing tariff costs, while others passed increases to customers, risking lost business. Inventory strategies shifted from just-in-time to just-in-case, tying up capital and raising warehousing costs. Legal teams pored over tariff details, searching for exemptions and clarifications. The experience was a wake-up call: supply chains needed to be more resilient and geographically diverse. U.S. buyers learned firsthand the risks of geopolitical shocks. The lesson: in a globalized world, flexibility and risk management are essential. The U.S.-Brazil trade standoff offers clear lessons for nations and businesses everywhere. First, over-reliance on a single partner is dangerous. Diversification is essential for survival. Second, speed and decisiveness in crisis response can turn setbacks into opportunities. Third, practical logistics and clear rules are as vital as high-level diplomacy. Finally, using tariffs as political weapons can backfire, disrupting economies and pushing partners toward rivals. In a globalized economy, stable, rules-based trade relationships are the surest path to shared prosperity. Thanks for watching a video, and subscribe the channel now. For more updates, thanks.